Hello everyone, my name is Apinyapon Seingyai. I'm from Insper Institute of Education and Research, Sao Paulo, Brazil. Thank you very much for this opportunity to present the paper, The Impact of Financial Regulation on Bank Risk and Performance, the Basel III Spillover Experiment. That is the paper that I'm working with Professor Klenio Barbosa and Rafael Matta from SKEMA Business School. So, this paper studied about the impact of the financial regulations that have been designed and implemented to prevent banks' misbehavior and financial instability. And this paper specifically, we study on Basel regulation. The key question is about the consequences of financial regulations, such as what will be the impact on the financial stability and crisis of bank risks and performance in the individual bank level. However, so far there's no conclusive findings, and most of the previous studies do not have causal estimation. Thus, this paper we intend to provide causal estimation of the effect of the Basel regulation on bank risk and performance by using this empirical strategy, which are the two features of Basel regulations regarding first. This Basel regulation is a sequential adoption of Basel in different countries, and it is covered under the ultimate parent rule, which means that the subsidiaries banks abroad from early adopters of Basel country have to comply with the same regulation as their parents. Thus, we have two groups of banks in the same country with respect to different regulations in the same time. In this case, we will call this study as the Basel spillover experiment, which is the ideal to obtain the different causal estimates. And we are the first paper to exploit the Basel spillover experiment. Regarding the research design, we have this illustration of how would be our research design. This is the diagram of the after Basel III implementation. So in this case, we will have two groups of countries, Basel III countries and non-Basel III countries. By that I mean Basel III countries are the countries that already implemented Basel III regulation, and non-Basel III countries are on the otherwise. So we will call the parent banks that reside in the Basel III countries and their subsidiaries that reside in non-Basel III countries, and we will call these subsidiaries as the treated. At the same time, in the non-Basel III countries, we will have the local banks and other subsidiaries from other countries that residing in the same non-Basel III countries, and we will call these two groups of banks as the untreated bank. Thus, that's the first difference. And the other difference is according to the diagram on the left-hand side, which is the before Basel III. Thus, combining all these two sides of the diagram together, we will have div-in-div estimation. The reason that we focus on the Basel III regulation is because we have the main components of the Basel III regulation, which focusing on higher and better quality of capital requirements and also liquidity requirements and improvement of the risk calculation. And why Basel III is important is that because it enhanced the bank regulation in response to financial crisis due to the off-balance sheet asset and liquidity shortage that led to the financial crisis in 2008. Some people might ask that why not Basel I and Basel II? Yeah, we could do that, and we already tried to do that, and we have the same consistent result. But however, those Basel I and Basel II, they were implemented during financial crisis that have, for example, during the period of credit crunch, dot-com bubble, or subprime crisis. Thus, we will not be able to separate those impacts from the impact of the regulation itself. Thus, the result might be contaminated, but that will not happen in the Basel III regulation. As I mentioned in the beginning that there are non-conclusive findings regarding the impact of financial regulations, For example, all this literature that I'm bringing on here, we have both positive and negative impact of the financial regulation, such as the impact on the bank risk and bank performance. The one that I highlighted in blue are the positive impacts, such as they led to the higher capital as a buffer for loss for the bank, or the lower probability of default or loss given default, or increased performance in crisis. On the other hand, they also have adverse impacts, such as it leads to the incentive to take risky policies of the bank, shorten credit supply, or decrease equity prices. Another thing of the paper that's very close to us, but we contribute to this literature in the way that this paper by Iyer et al. In 2014, they study of causal estimation of financial regulation. They explore the spillover effect of the UK financial regulation on lending from UK banks to their subsidiaries in another country. Differently, we focus our study on behavior of banks in countries where Basel III regulation haven't yet implemented. And not only that, we also analyze the impact on profitability and risk-taking besides only the amount of lending that Iyer paper have done. Thus, we have results in focus in two components. The first one is the compliance effect. Why do we call that? Because this Basel III regulation requires, especially in the Tier 1 capital, redefinition. And on the other hand, we also look at the outcome variable regarding the effects on the risk and performance. This is the outline of the presentation. I'm gonna talk briefly about the institution background and data, and then I'm gonna focus more on the identification strategy and main results, and then conclusion. Regarding the Basel III regulation, we have a lot of components under the regulation, but only one that was already officially implemented is the redefinition of the capital that was already implemented in 2015. Another component of the Basel III regulation will be, for example, liquidity coverage ratio will be officially implemented in 2019, gradually from 2015. Thus, we will still not have enough data to study the impact of this additional requirement of the Basel III. Therefore, we will define the treatment period in our study in 2015 in the requirement of the new capital definition. What is new? If we go back to Basel I and Basel II, regarding the BIS ratio, we will have that the capital as the numerator and the risk-weighted asset as the denominator, and we will have common equity tier 1 as 2%, additional tier 1 as 2%, and tier 2 as 4%. But under the Basel III, it requires much more in the higher of amount of the capital common equity tier 1 from 2% to 4.5%, which comprises such as common shares, retained earnings, or reserves that are the better quality of capital, that has a better quality in the sense that they could buffer more, is the stronger capital that could buffer the loss that could occur to the bank. This is the map of the Basel III implementation of each country. We have the darker area of the countries that are early adopter, and then the brighter area will be most of the country that we will study on, which are the countries that haven't yet implemented Basel III. And this is important, Basel III scope of application, because it applies to the holding company as the consolidated basis. Thus, even though those subsidiaries of the parent bank that reside in the countries that already implemented Basel III, when they reside in the country that's not implemented Basel III yet, those subsidiaries still have to comply with the Basel III regulation, the same as their parents. The data that we use will be the bank level data, which is very good, that we could see how the individual bank level how did they change their behavior in terms of the risk and performance. And we use the data in terms of balance sheet, income statement, stock market data, merger and acquisition data. The sources we use from Thomson Reuters and Orbis Bank Focus. And the period of study is from the annual data from 2010 to 2017. We also have to use the ownership data preparation in order to define what are the parents of each subsidiary that reside in the non-Basel III countries. And we define them as whenever that they have those acquired percentage more than 50% of the share as the parents during the period of study. With that being said, we have to exclude something here, which is banks that switch groups of parent banks during the period of study, or banks that switch the status, whether sometimes they're being subsidiaries, sometimes they're being their own parent themselves. Also, subsidiary that parent banks incrementally implemented Basel III during the 2015 to 2016, and observation of banks after they implemented Basel III, and outliers, and this spatial variable, which is the ratio of NPL to loan, and this is one of the outcome variable that has most of the missing data. So we have to exclude those banks in order to have more consistent result along with all the outcome variable. Thus, we have the final sample of 230 banks from 41 countries, accounting for around 1,365 bank year observations. Regarding outcome variables, we will have three groups of outcome variables. The first one is the bank risk. That the first variable will be the compliance effect, which is the Tier 1 capital ratio. And then we have other things such as total capital ratio, liquidity ratio, ratio of NPL to loan, C-score. Regarding portfolio variable, we have the loan growth, and then performance variable, we have profitability, such as return from lending activities, net interest income, return on asset, or return on equity. Okay, so regarding the different indifference approach, we will have to have different bank groups, right, in the non-Basel III countries. So we have first group, treated banks, that are the banks that are subsidiaries of the parent bank that already implemented Basel III from 2014. Thus we have from 22 countries, 42 banks. And then untreated banks, we have the local banks and subsidiary of non-Basel III countries banks, or we call others. Altogether, we have around 42 countries and 188 banks. So the main identification strategy we have here is different indifference approach. As I mentioned before, we have treatment group and control group. And this is our main specification. So we have on the left-hand side, which is the outcome variable, Y, which is the risk or performance measures of the bank I in country C at time T. And C are only the country that we call non-Basel III countries. And then we regress them on the right-hand side, which is the bank's fixed effect, country year's fixed effect, and then post variable, which is equal 1 after 2014, and then dummy variable DI, which is equal 1 if that bank is from a Basel III country, or we call treated bank. And also we control for such as the main activity of the banks, the size, the liability, and non-main activity income. This is the main results. The first one is the compliance effects. Why do we call compliance effects? As I mentioned before, since this is about the redefinition of capital, especially in the Tier 1 ratio. And then we have it consistent with the new requirement, which is a higher amount of the Tier 1 ratio, about 2.6 percentage point of the bank that's already implemented Basel III. Regarding liquidity, we have also increasing in the liquidity ratio and deposit growth of about 4.3%. Regarding the bank risk, the first variable, which is the performing loan, we have it increase as well, and we have it decrease the NPL and NPL to loan ratio. In terms of the profitability, we have it increase. The bank has already implemented Basel III. They increase customer loan income, net interest income, ROA, and ROE. So we come to the conclusion of the main result, which is that we have main findings of the first compliance phase. We have subsidiary raised Tier 1 capital by about 2.7 percentage point, effect on risk and performance of subsidiary banks that they, in terms of the risk variable, they decrease the NPL, increase the liquidity, improve profitability, and performing loan. Thus, it seems like Basel III doesn't seem to hurt implemented banks. But why? Probably that's because of the mechanism of the coordination effect, shifting from the risk to safer equilibrium, or about the one of the things that we proposing is due to the competition channel, which means that in non-Basel III countries that have more competition between the local banks and the subsidiaries from the Basel III countries, the higher competition, the higher that the effect could be, which means that there will be more improvement of the subsidiary in terms of their improving in the performance, profitability, and reducing their risk, comparing with some other countries that have less competition between subsidiaries and local banks. In that sense, we might find that the impact of the Basel III implementation would be less. Thus, we did some robustness tests to check this competition mechanism and many other type of robustness tests. And if you are interested in all the detail of this robustness test, you can check on my paper as well. And to conclude about the robustness test, we have really found that in the competition mechanism, we have higher competition, we have higher effect of the Basel III implementation. Regarding the other robustness tests, we test the regions, like separated the result, the sample into different regions, and we have that generally it's consistent with the whole data, but except sub-Saharan Africa. We also study the financial deepness in terms of the private credit and stock market capitalization. And what we found is that they're more consistent for the whole data for countries that rely more on credit from banks, which is intuitively right, because the more that they rely on the banks, then the higher impact should be for those kind of banks. So to the main conclusion, we have that the Basel III doesn't seem to hurt implemented banks. Competition is tested as one of the mechanisms, and the results are generally consistent through different regions and measure of financial deepness. Thank you very much, and if you guys have any more comments or question, please send it to me. I really appreciate that. Thank you very much.